Hello and welcome to Stockwatch Live. Now, boxes, plastics and fasteners. If you like your company's niche and focused, then the week ahead has plenty in store for you. High street names they may not be, and glamorous these businesses certainly are not, but as DS Smith, Britain's biggest box maker and supplier to online giant Amazon, demonstrates, these niche industries can be big business. In March, the FTSE 100 company agreed to sell its plastic division to private equity group Olympus Partners for $585 million. That news would have been welcomed by shareholders, who have seen debt levels rise after spending billions of dollars on acquisitions. The company said that selling the unit, which primarily makes plastic bags that go in boxes for distribution of liquids such as wine, would allow it to reduce its leverage following its recent acquisition of Spanish rival Europac, and also allow it to focus on its core fibre products as environmental concerns on plastic usage rise. Plastics wasn't our focus, Chief Executive Miles Roberts told the Financial Times. We weren't putting our efforts in plastics, it's just not where we see the future, he said. As I mentioned, the company's borrowings have increased substantially in the past number of years as it snapped up rivals, including Sweden's SCA Packaging in 2012 for €1.6 billion, US-based Interstate Resources in 2017 for $1.1 billion, and most recently Europac, which came with a price tag of €1.9 billion. By contrast, though, the sale of the plastics unit is expected to bring in net proceeds of around £400 million. DS Smith warned last year that its expansion plans in its home market in the UK had been heavily scaled back due to the uncertainty surrounding Brexit. However, it recently said it expected margins to improve further in the second half, and it should meet market expectations. In a trading update for the financial year to April, the company said it had seen ongoing growth in corrugated box volumes and market share gains, driven by a resilient customer base and strong position in the e-commerce packaging market. In fact, it said all regions have seen growth, particularly the UK, Italy and Poland. The UK accounts for just 10% of the company's business, though. And Mr. Roberts said international expansion, a rising trend in the industry in recent years as producers look to gain economies of scale, pricing power and cost savings, would continue. Investors will want to hear whether the plan is still to focus on the integration of Europac and the US, a market it entered in 2017 with the Interstate deal. Broker Berenberg rates the shares a buy, but has cut its price target from 500 to 480 pence. On Tuesday, it's the turn of Halma, another FTSE 100 company, and one that has the habit of turning in a solid performance. As a result, it's long been a favourite among investors. Made up of around 40 individual companies that supply what can be called life-saving technology, everything from fire alarms to eye testing equipment, it may not be a household name, but what has set pulses racing amongst the investment fraternity is its more than a decade of unbroken double-digit earnings growth. And Tuesday's results shouldn't see any deviation from that trend. Halma has said it expects annual adjusted pre-tax profits to meet market expectations amid strong growth in its US and UK businesses. Market expectations for adjusted profits for the year are in the range of £240 to £253.5 million. And it hasn't been playing it safe either. Halma made 3 acquisitions in the second half of the year, all in infrastructure safety, for a cool £62 million. The latest was in January when it paid around $32.5 million for Rath Communications, which provides emergency communication systems for areas of refuge in the event of earthquakes and so on in the United States. Broker Exane BNP Paribas recently downgraded its investment rating on Halma to neutral from outperform, but raised its price target by £1 to £16.50. Deutsche Bank is altogether more bullish, rating the shares a buy and lifting its price target by £4.70 to £19.60, while Jefferies International is in between, having downgraded its investment rating from buy to hold, but raised its price target by £2.85 to £16.75. Finally, keep an eye out for full-year results as well from Trifast on Tuesday. A specialist supplier of industrial fasteners, screws, nuts and bolts and that kind of thing, to the likes of Nissan, Philips and Foxconn, which makes Apple devices, its main markets are automotive, electronics and domestic appliances. However, as the consumer-orientated nature of its business suggests, tightening consumer belts and things like the shutdown in the car industry during April have proven to have a knock-on effect on Trifast's fortunes. While it says it posted solid revenue growth in the first 5 months of the year, Margins have stayed under pressure, although it's largely put that down to spending on investment. However, it insists that domestic and international demand remains reassuring across both Asia and Europe. The US is where it can see the most potential for growth, with a relatively small market that it says is growing exceptionally well within the electronics and automotive industries. Until things start to turn around though, broker Shore Capital has downgraded its investment rating on TriFast from buy to hold. And that's it for this week. For more on the companies as they report in the week ahead, go to the Markets and Insights section at fidelity.co.uk. See you next time.